Good morning. Happy
Good
Friday.
Morning.
How you doing?
How,
We're doing good. We're doing good. It's Friday, right?
It's
Grant, you look like
Friday.
you look like you have a nice suntan.
Do I?
Yeah.
Maybe after in a couple weeks I will. After spring break.
There you go.
Got a whole lot of sun today.
All right. Well, I am Rachel Gallegos.
Tim Bonsoir.
Grant Alexander.
Just jumping on to go over what happened in March in real estate and in mortgages and all the fun stuff. So we'll start with you, Grant. You can tell us a little bit about what you saw happen in March and maybe what's expected to change going into April.
Yeah, so over the last few weeks, we've definitely seen some mortgage rates on the rise. They're still near historic lows, so they're kind of what we saw at the beginning of 2020. So we've kind of moved away from the all-time lows of the mid twos on a 30-year mortgage. We're probably looking into the high twos, low threes for a 30-year now. However, I think there's a lot of people out there that maybe were thinking about refinancing or thinking about buying, and they're trying to time the market. And, historically, people that try to time the market are not very successful, or maybe they need to do fixed credit or save up some money, whatever the reason is. It's still a great interest rate. People that were looking to refinance, there's 19 million people in the United States that are still what we call in the money for a refinance, even though interest rates have climbed, where they could lower their interest rate by at least 0.75%. So there's still a lot of opportunity out there. A great way for me to explain this, I feel, is like in 2005, people were like, man, I wish I would have bought stock in Amazon in 1998. And then now they're like, man, I wish I would have bought it in 2005, or, whatever it is.
Yeah.
If it still benefits you, you still need to look at it. Don't put it off. Don't try to time the market.
Right.
And when it comes to purchasing a home, interest rates really don't drive that factor all that much, because it has more to do with a need, a want, a desire to own property, to start investing in real estate, whatever it is, rather than just saving money. Interest rates don't drive it as much. However, it does affect affordability, and affordability is still really high, because with rates in the low threes, that low rate still creates a lower mortgage payment, which is lower than rent in a lot of cases. So it's still a really good time to buy. So don't let the interest rates right now discourage you.
Yeah, I do feel like the articles you see, it kind of plays into that fear mongering of, interest rates are on the rise. And it's like, they're still very, very low in comparison to what we've seen in the last 10 years. So,
yeah, obviously, I think everyone watching this knows that positive headlines really don't get a whole lot of attention, right?
Mm-hmm.
So anything that, the fact that we are at the same level as we were last year, and we were bragging about the rates then, and now it's a bad thing. That just, I don't really see that. Now, one thing that we do see coming up here through April, May, and June is inflation is going to hit. Like it's not like a question of whether or not it's going to happen. It's going to happen. And so a couple weeks ago, the Feds had a meeting, and they pretty much said that they're going to keep rates, the Fed rate at 0 through up till 2023. Okay. So that meeting went over, and, they kind of just ignored the inflation aspect that's going to come up. Well, when that happens, the market has to be the bad guy, right? The market's not ignoring inflation. So the market goes, okay, Feds, if you're not going to do anything, we're going to have to do it on our own. And that's when you start seeing these interest rates creep up. Now, we do think that they're going to level off or come back down a little bit towards the end of the year, third quarter, fourth quarter. But, there's no question that we can't be printing money off at the rate we are. And there's another thing here that, believe it or not, affects interest rates is There is a gigantic cargo ship stuck in the Suez Canal. I don't know if I'm pronouncing that right, but this cargo ship is as long as the Empire State Building is tall, right? So this is majorly, like, I think 12% of all imports exports go through this canal, and it's a major problem, and it's stopping stuff, and it does cause inflation when you can't get, you know, certain things. Even toilet paper, they're talking about that the pulp used for the paper, that they're having a hard time getting it. And
don't say that, Grant.
I know, don't go off stampeding. We'll go stampeding Costco right now, but
right.
All these things which increase inflation do end up affecting mortgage rates. You know,
for sure.
They're not.
Yeah. Now, where do you kind of see it going in the next 90 days as far as, you know, what we'd be looking at for interest rates in, you know, 30, 60, 90 days? Are you expecting a slow climb, or are you expecting it to kind of go up pretty quick and then maybe start coming back down third quarter?
There's a lot of stuff that needs to happen that will actually cause rates to go one way or the other at a flip of a coin here, flip of a hat, because the jobs numbers coming out next week, that'll be one thing that depending on how those numbers come out will affect how interest rates go. Basically right now, we're locking most clients, you know, as soon as we can, just for protection. We are at a stage that we call cautiously floating, meaning like, hey, we might not be locking because we're not sure where we're going, but like any sign of negative information, it's locking the loan.
Right.
Most cases in purchase transactions, we're locking at the beginning anyways, because we don't want that fluctuation or something bad to happen, you know, in the middle of a purchase transaction. But right now we're cautiously floating. So what that means is basically like it could stay pretty steady, but at any sign of negative information, you know, it could start to tick up. I don't think we're going to be 4% anytime soon, but you know, I think I locked a low score conventional loan below 680 at 3.3%. I mean, that's still really good. That's low. That's low score. So like,
now,
yeah.
How long, once you lock an interest rate in, how long can you lock that without having to pay fees to extend the lock?
It depends, because there's different lock periods. So you can lock it for 15, 30, 45, 90 days. However, the longer you lock it, the worse the pricing gets. So like, let's say you could lock something at 3.25%, and not pay any fees, no underwriting, no processing, no discount points, right? But if you wanted to do that, then you did that on a 30-day. If you wanted to do it on a 40-day for that same rate, it might cost you 1/8 of a point to get it.
Gotcha.
And for even longer, it might cost more or have a higher rate, one or the other.
Yeah. Anything that you're seeing as far as you know, buyers that you are, you know, representing as the loan officer? Anything you're seeing that you haven't seen before that they're doing on their purchase agreements to get their offers accepted?
I think, you know, I'm not going to beat around the bush. If you do not have liquid assets, it's going to be tough.
Yeah.
If you do not have liquid assets to be able to cover your own closing costs, to possibly cover some gap in appraisal, you don't necessarily always have to get crazy. But one thing that I've noticed is, you know, so we're here in West Michigan, right? So we're talking mostly like the condensed areas of Ottawa and Kent County. Is you might want to look at buying further out. You might want to look at commuting, because you know, I get purchase agreements in like Muskegon and, you know, areas south of here, between here and Kalamazoo. So where it's a little bit less competitive and it gets a little bit less crazy. So like that might be one thing to look at. But you know, it's hard when I have a client come and they have enough to put 5% down, but not a whole lot to do much of anything else. It is difficult to be optimistic about that, because you just know where that, and especially if you know where their price range is, like, you're 150 and you only have enough for your down payment. Like I try to be realistic. I don't want to like burst anyone's bubble, but I want to make sure we're setting the right expectations. Like, hey, it doesn't mean you shouldn't go out there, but you just know you're going to have to go through a process, right?
Yeah.
You might get shot down quite a few times before you even hear of this house that so-and-so might be selling off the market that you need to go after. So that's what we're seeing. That's what we're seeing a lot. I get in a lot of discussions on the market, where it's heading, and there's a lot of people that, talk the bubble talk. And I get into pretty deep discussions because a lot of people like to think that there's this bubble happening solely because of how quickly houses are increasing in price, or the types of offers that are getting submitted at 50,000, 60,000 above asking with appraisal gaps for the same amount. But raising prices going up isn't what causes a bubble. There has to be an object there of resistance that causes that bubble to burst, right?
Correct.
There has to be a lack of inventory. There has to be massive job loss. And if we haven't already had massive job loss, I don't know what we're going to have as far as that goes. And massive defaults. And I don't see
but like
that
massive defaults.
Not only massive defaults, but ones that continue to happen month after month.
Yeah.
Because if we have massive defaults, I think we've had this discussion before, they're not going to flood the market all at once. Even if it's like if one bank has 100 houses in West Michigan, they're not going to let's list them all this week. They slow roll them out because they're not going to dilute their own asset. And so, and the differences, especially between 2007, 2008 and what's happening now is, so let's say someone buys a house at 300,000 and they went $60,000 over asking price and it only appraised at 240. I'm going really extreme here, right? And they had to do this $60,000 appraisal gap and put 20% down past that, right? Like, what's the risk? I mean, the risk is that they're going to lose their liquid assets that they used in that case. But in that scenario I just said, their loan amount's $192,000 if they covered a $60,000 appraisal gap and put 20% down. $192,000. That means that the property value on that house would have to go from $300,000 to $192,000 for them to lose all their equity.
Correct.
That's 35% drop. I don't see how that happens.
So you're right. The risk is losing liquid assets, not going in with negative equity, right?
Exactly.
And not only that, but that's only the risk if you're planning on selling within 4 to 5 years or less, right? If you're going to stay longer than that, the risk is gone because it's a long-term investment, right? It's not, I don't know. You got to look through it through the mindset of, lifestyle and, legacy compared to financial, and, it doesn't make sense. If you're going to stay for a long time, it doesn't matter.
It's just like your 401k. Okay. In 2008, you saw headlines where people lost their entire retirement. No, only if you cashed out.
Yeah.
Or only if that company went insolvent or something like that. But it really sucked back then for those that were at retirement age. Like, hey, I'm about to retire. Boom. Now I can't. But everyone that had a 401k then that didn't touch it has recovered and then some since then.
Right.
So the same thing in real estate. So sure, if the market drops 50%, which is catastrophic, right? 50%. And then you're like, hey, I want to move. Maybe you can't, but that's, maybe you got to stay a little bit longer. It's just, I don't see how that happens. And it all has to do with affordability. So it's it's only really becomes a problem when you're forced to move because of a job or loss of job, or your payment goes up, which doesn't happen when you have a fixed rate mortgage. So, back in 2008, these people, I could afford it. Now I can't because my payment just tripled because they had an adjustable rate mortgage that adjusted, so there's all these factors that I'm not just trying to compare to 2008, but I'm just trying to see like, okay, this just because values are increasing, I just don't see that yet. And I'm open to it. If you can provide me with it, is that that pin that burst the bubble. I don't see it.
Right.
Building costs are going up. Right.
Well, and also with the thing that's different with 2008 right now, and everyone's saying like, oh, there's all these forbearances once those are done. And once, the, government stops giving, putting out these programs for these homeowners or whatever, that everything's going to go into foreclosure. But the thing is because the interest rates are so low, we have so many buyers in our market. Even if you added, we talked about this, 2,000 homes to the market in a matter of a month, you still have enough buyers to eat those up. And so you might be balancing the market, but you have to have a significant amount of foreclosures hitting the market to balance our market out.
Well, here's the other half of it. Okay. Out of all those supposed people that are like on the verge of foreclosure, just can't happen yet because of the government regulation, how many of those people have equity in their homes right now?
Right. Yeah.
A ton. Probably all.
Yeah.
Unless they like recently bought and put very little down, maybe not. Maybe after transaction fees and stuff like that, maybe there isn't enough equity there. But the majority of people that purchased 2 or more years ago that are in foreclosure issues right now have equity on their home. And really what they need to do is they need to reach out to you guys, real estate agents, before the government says that banks can foreclose. You need to do it before.
Yes. You sell it and then you walk with cash in your pocket rather than
and you rebuild from there. You have tons of cash in your pocket. More than likely you have a substantial amount. And by the way, if you've lived in that house as your primary residence, according to current tax laws for 2 years, 2 of the last 5 years, you don't pay capital gains on what you make in the sale. So like you could have 2-3 years worth of rent or more
in your pocket.
In your pocket. Like while you get another job, while you rebuild.
And your credit doesn't get destroyed.
Right.
And,
don't let that foreclosure happen, because when that foreclosure happens, it's going to stamp it with a time frame of which you're going to have to wait a minimum of 2, 3, 4 years until you can buy again. So, I mean, it's a tough situation, like in our position, right? Because we obviously work in real estate. We have a vested interest in people listing their house, selling their house, and people buying houses, right? So when we give advice to people that, hey, if you're in foreclosure, like you need to reach out to a real estate agent, it sounds really disingenuous because it sounds like we're trying to make a sale, right? However, like so many people, when it comes to foreclosures and things like that, they're ashamed, and they shouldn't be, especially when it's pandemic.
Especially now. Yeah.
And so like for me, I have to brush off like this feeling of, well, people are going to think I'm taking advantage or taking advantage of a bad situation. And it's like, no, what I don't want to do is someone to let a foreclosure, even just a share sale happen when they have equity on the table. Right.
Yeah.
And if they go that 6 months redemption period and let it go back to the bank, like it'll make me sick to my stomach that they probably let 20 tens of thousands of dollars of equity go to their bank.
Just threw it away. Yeah. All right. You got anything else for us, Grant?
No, sorry. I think I ranted enough.
we love ranting with you.
Yeah.
Awesome. Appreciate you guys.
Grant is a wealth of information, kind of a play on words there.
There you go.
Thank you.
All right, Grant. You have a good weekend.
Awesome. You too. Take care.
All right. Thank you.
Okay, so
he's got a lot of info, doesn't he? I love listening to that guy. I'm like, wow, and it's just knowledge that's right there, and it's good. It's valuable information.
I agree. Yeah, I like him and I usually have we get on the phone, and then when we hang up, I look and I'm like, oh my gosh, I just talked to Grant for 45 minutes.
Right. Yep.
So, all right. So I will put up the numbers for March, just like in months past. They are not whole for March 2021 because it is only March 26th, but these are the
Right.
numbers that we have so far for the month.
Correct.
So this month, 193 sold, 30 days on market. 30 days on market is the average.
Yeah.
Now that is from
The time it's a signed contract until closing day.
Until closing.
Right.
Average sale price is 333,629. So if we compare it to last year, and you and I talked about this as far as our numbers for this month, if you took the average, the 193 divided by 26, it's about 7 a day. So if we were to add about 30, right, we'd be at 220.
Yeah, we'll probably end up about in the 220s.
Yeah.
By March 31st.
So better than last month, right?
Yeah.
That's
Definitely
encouraging.
better than last month. Yep.
But look at compared to last year, right? We did 309, so significantly less. But days on market falls every month, I feel like, and it's understandable considering the climate that we're in with our market right now.
Correct.
Same with the average sale price. I mean, up 13,000 from last year or last month.
Last month alone, yeah.
Up 66,000 from last year.
Right.
So
that's pretty significant.
I feel like,
as you can see, again, like we talk about, the inventory was much higher last March. 309 sold. This month will be in the 220s. So that's about a 25 or 30% less with fewer houses on the market. Again, supply and demand kind of thing. So the average sale price is going to go up. One of the things that Grant mentioned, though, that I kind of going back to something he said, is that affordability really can't be the driving factor, even though affordability is in a positive place when you consider that people have buying power due to the fact that the interest rates still remain low, even if not historically low, still very, very much low compared to years past. So the needs and the wants are there. They're just a little bit pent up, and so we got to get folks to understand that if there's something in your life, there's a need and a want, the affordability is going to be there for this, forever. How long still?
Well, and I think that people are.
And like Grant said, if they're waiting for, just the right conditions to hit, that's not a good roll of the dice, I guess. And
to be honest with you, I don't see things changing anytime soon. At least not this year. I think that we're gonna, it's gonna kind of stay the way that it is. Hopefully, it cools down a little bit. It's getting to the point where it's not as fun as it used to be. It's a challenge for buyers and even for sellers. It's I mean, it's easy for sellers because they're selling so quickly, but it's a little overwhelming. You know what I mean? You go on the market and it's like, well, you got to leave your home for 3 days straight. So I just think that I know I've said this time and time again, but the average sale price is up $66,000, and our interest rates. Our interest rates are lower. So if you are somebody who has to sell and wants to buy, you're looking at a ton more equity than you had last year, and a more buying power than you would have had last year because of interest rates. So it's kind of like there's two pros there. I mean, don't get me wrong, there is a negative as far as availability and what you're going to find. But I mean, there's
and a lot of folks too are a lot of buyers are like not looking as closely at the purchase price as they are what's my monthly payment going to be?
What's my monthly payment going to be?
What's
Yep.
my monthly payment going to be? The selling price might be higher, but your monthly payment is still going to be manageable due to the fact
Yep.
that interest rates are advantageous.
Yeah, I did a live, oh gosh, it's probably been 6 months or so, but I did a whole breakdown of, hey, if this is what you sold your home for today compared to last year, this is how much more you're going to net, right? And if
Right.
you were to
Yep.
have bought a home last year compared to this year with the lower interest rate, this is what your monthly payment's going to be. And right now, I feel like you have the opportunity, if you're selling and buying, to essentially only increase your monthly payment by maybe $100, right? You're
Right.
moving up 100, you've been in your home for 5 or 6 years. You can afford a little bit more monthly payment now. You go
Right.
say, I can afford $100 more a month, then a dollar amount that equates to when
Right.
you have a huge down payment from your net proceeds of your sale,
Right.
it's a huge jump. It's a huge jump. A much larger gap than we've ever seen for, dual transaction clients.
Right.
It's literally the best time to do it. It's just a matter of, again, having faith in the system and faith
Right.
that things are supposed to work out the way that they will, and faith in your real estate agent that they're going to make sure you're protected and, not going to be homeless. So yeah.
Well, yeah, and that speaks to one of the fears that some of our buyers, or not buyers, but people that are looking to list have said, if I list, I want to make sure that I'm going to be able to, be able to have something that I can move into in that process, like you said. And one of the things, like, I think what we've seen is that sellers are willing to go out further for their possession time, giving people more time to find something. So I think
for sure.
that's working out well too. So if there's a fear there, just if you're selling, just your closing date can be pushed out based on the fact that you have to find something in the meantime, and people buyers are willing to work with you on that.
The thing is buyers right now, I can almost guarantee you 90% of the buyers that are in the market right now have gotten an offer declined. They've lost.
Oh, sure.
They've written more. They've been writing offers on more than one property.
Multiple
and
times,
so
yeah.
If you have a seller that comes back to you and said, after you've written offer after offer after offer, and you can't get your offer accepted because you're getting beat out by cash buyers or people who are willing to bring, $30,000 for an appraisal gap. If you have a seller that comes to you and says, we really like your offer, can you give us 60 days possession, or can we bump our close date out 60 days? I can guarantee you that buyer is going to be absolutely. So I don't have to keep looking at houses and keep writing offers. So it's doable. The buyers
which alleviates the fear. Yeah, it alleviates that fear, that concern that you're not going to have time to get into anything else. You do have time.
Yeah. All right.
Cool.
Anything else you got?
No, just kind of maybe mention some of the things that we're doing in the community here with our Meet the Zeal episode.
Filmed our latest episode yesterday. It'll go be on Monday. We went and talked with Shelly at Drip down here.
Yep.
So
right here in downtown Zeeland.
We're excited.
So that's a fun thing when we're doing. Yeah, absolutely.
All right. Good. Well, next month it'll be warmer and sunnier, hopefully. And hopefully everyone will be well rested from their vacation that hopefully they get to take at the end of this month.
Right.
So, all right.
Good.
Have a great weekend.
All right. Great. See you, everybody.